Netflix just reported earnings to kick off earnings season for technology stocks. We've got a lot of big names coming up in the next couple of weeks, like Tesla and Amazon, which I'll definitely be covering on the channel here. But the Netflix Q1 report was a mixed bag. Now, the company posted a great quarter, but they forecasted a weaker second quarter than expected. And I anticipate we're going to get a lot of ugly Q2 guidance to come from other companies that are set to report here as well. Now, if we just take a quick step back and look at the market has been on fire. As you can see, we had 12 straight weeks to start the year off, stocks going straight up. But you see in the chart here, the last 3 weeks, we've had three weekly red candles, a very big one this past week. And you had that deep red close, and the market's already down 5.5% from that. It's still up around 4.6% for the year, but the market was on fire. It looks like we might be in for a little bit of a cool off period here. Now, the market's been going up on a lot of AI based hype and hoopla, accompanied with the expectation that we were going to get these three rate cuts this year. And it's starting to look like the rate cuts may be off the table, might even get a rate hike since inflation just does not seem to be going away. On that note, if we just take a look at this chart here on inflation, it's worth addressing because, the media likes to mislead you whenever they discuss it. For example, March, that we just had the inflation report, CPI inflation was only 3.5%, they'll say. They say this as some justification, like inflation is decreasing. The reality is that this is a year over year number. So if we look at inflation March 2024, 3.5%, that means it was only up 3.5% over March of 2023 when it was up 5%, over March of 2022 when it was up 8.5%, and so on. You get the picture. So the reality is, if you add up all these numbers, you go all the way back to 2020, for the month of March, you'd get the actual inflation rate in 2024 compared to what it was in 2019. It is 21.1% higher now. So your dollar is worth 21.1% less than it was in 2019. Goods are indeed 21.1% more expensive. So inflation may be decelerating, but it has not gone down. It is only up since 2019. And the picture gets even worse when you look at things like food, energy, insurance, housing, basically everything that's essential. But, it's not all bad. At least we've got meme coin making fun of Joe Biden. It's called Geo Biden, up over 160,000% in a month. There's the logo for it. So like the saying goes, there's always a bull market somewhere. So let's take a look at the Netflix report and see if the company is still worth investing in. Netflix, I've been saying this, is the clear streaming winner of the traditional players. Been talking about this on the channel here for years. Netflix is very similar to Tesla in that regard, in that they were the first mover and they're simply just the best in class. Now, they had a good report, but because their Q2 guide missed estimates, accompanied with the decision that they're going to stop reporting quarterly subscriber metrics, that spooked investors. So that led to the stock dropping nearly 10% on Friday alone. It's down 12% in the last week. Now, neither of those things matter. I will touch on two things that we should worry about later. As I said, I think many companies are in for a rude awakening Q2. You just look at those inflation numbers I just mentioned, and you understand why. Now, the decision to stop reporting subscriber metrics is not out of the ordinary. Apple did something similar in 2018 when they stopped reporting unit sales. Netflix said it's because it won't paint an accurate picture anymore. The business has changed. There's so much more to the Netflix business now. They've added things like an advertising tier. They've got all sorts of different countries they operate in with very different tiers and pay scales. So when companies reach a certain size, these sorts of numbers become less relevant to giving you an idea of the full picture of the business. That was the case with Apple, which has a lot of revenue streams. So I'm sure that the Netflix subscriber numbers will also be slowing down a lot by 2025 when they're set to axe the metric, and there's some intentionality there. They've squeezed all the juice out of this thing they can. The tailwinds from the whole cracking down on the password sharing will probably have been realized by that point, if they haven't entirely already been. But the company said, as we've evolved our pricing and plans from a single to multiple tiers with different price points depending on the country, each incremental paid membership has a very different business impact. So the picture has changed a lot. The subscriber metrics alone don't tell the whole story. Now, in 2023, they had already stopped providing quarterly paid member guidance. And starting in 2025, they're going to stop reporting quarterly membership numbers, as well as the average revenue per member or ARM. As I said, this differs greatly by country. They've got different tiers, and now they have more revenue streams, things like advertising. Now, as I said, so the company beat estimates. If we look at the chart here, you can see they added over 9 million subscribers in Q1, while revenue grew nearly 15%. They projected just under 60%, 16% growth for Q2, and the stock went down 10%. I mean, what more could Wall Street want? But for the full year 2024, the company expects revenue growth between 13 and 15%. Great. All sounds fantastic. Now, Netflix, interestingly enough, is used in 270 million households across more than 190 countries with an audience of over 500 million people. No traditional media company has ever reached this scale. I mean, what they're doing is really unprecedented. And the fact that while they've done that, they've managed to maintain and grow the share of their US TV viewing, which was up versus, the recent few quarters here, you can see to 8.1%. So how much people are choosing to use Netflix versus other streaming options. 8.1% is going to Netflix. So there's definitely still a lot of opportunity to capture market share from, the slow death spiral that cable, traditional media, these more traditional businesses find themselves in, the predicament they're in. But outside that, I think growth is going to be very hard to come by as the battle for people's attention span has become hyper competitive. At any given moment, we have 100 things competing for our attention, right? So Netflix has taken up the strategy of broadening their offering, which I think they've done very well, right? Some recent examples of which are, in addition to appealing to different cultures around the world, they're doing well adding specific niches to their offering. For example, they're going to be streaming a live boxing match between Jake Paul and Mike Tyson this summer. That's an event that's sure to draw in boomers and Gen Z alike. They made an exclusive deal to broadcast WWE Raw, which is sure to bring a unique and special group of viewers as well, give them, some exposure to live sports, live events, something they've been lacking historically. And they're really ensuring that they have something for everyone. And Netflix, hands down, has the best content library of all the streamers right now by a long shot. This is in addition to a wide variety of entertainment that is consistently seeing the top rankings. They had the #1 streaming movie for 8 of the first 11 weeks of the year, as well as the #1 original series for 9 of the first 11 weeks. So they continue to thread this needle very nicely. Financially, things are looking great. Netflix continues to buy back shares. They bought back $2 billion worth of stock in Q1. So it all sounded great. Let's take a quick look at the two problems that I see emerging long term. For starters, we have declining attention spans, or as I like to call it, an attention span race to the bottom. Will millions of semi-conscious Americans be able to sit through a 2-hour Netflix movie in 5 years? I'm genuinely asking you. Or will they opt for 2 hours of mindless scrolling through TikTok instead, TikTok videos? For the sake of us all, I hope that this trend doesn't continue, but all signs are pointing toward the attention spans continuing to shrink. So on this note, I think that the first problem is that the playing field has drastically changed from Netflix competing with traditional media to Netflix competing with literally everything else for people's attention, like phones, social media, YouTube, just to name a few. A 2024 spring survey found that teens spend 29% of daily video consumption on Netflix, which was down 2% since the spring of the prior year. They also spent 27% on YouTube, which was down 1% from the prior year. So competition's fierce, and it's extremely difficult for Netflix to compete with YouTube. Should that become their main competition, as YouTube brings in more revenue than Netflix with none of the production costs. It is just a much easier business model. The second problem is big tech players. Now, Google and Meta, Meta, formerly Facebook, fit into both problem 1 and 2, I think. But in the second camp, we also have Amazon and Apple that are a huge problem emerging for Netflix. The threat from Google and Meta is, again, more of that short form content, similar to TikTok and shrinking attention spans, or maybe alternative media, however you want to look at it. But now, alternative entertainment, it's really all just boils down to entertainment at this point. But now you also have the bundling capabilities of a company like Amazon and Apple to contend with. Now, the bundling business model is a bit monopolistic and extremely difficult to compete with, but it remains legal for now. There are examples of pure players continuing to thrive despite it, Netflix and Spotify being great examples. despite the entrance of things like Apple Music, Amazon Music, YouTube Music, and 7 others, Spotify continues to grow and maintain its huge lead, right? I think it is just that much better of an experience. But, companies like Amazon, they have deep pockets and major advantages. Prime Video is just the cherry on top of an incredibly useful product in Amazon Prime. They're getting better too. Their shows, their content. I just finished watching Fallout. It was great. Amazon could shower endless money into streaming if they wanted to. I would not want to compete with them. And then you can just take a look at this chart here. Again, it's kind of Netflix and YouTube neck and neck. As of fall 2023, for the first time, YouTube leads in video consumption. So Netflix and YouTube neck and neck. Everybody else is way behind. I'm not worried about any of these other players besides Amazon Prime. I think long term is probably going to compete as a top 3 player on this chart. So Netflix has their work cut out for them. YouTube is major competition. I outlined their major advantage, and then on this chart, like I said, I think Amazon Prime, YouTube, those are the only ones I'm worried about for Netflix. But that's a huge, competitor. That is a big factors right there. So there's opportunity to grow still as the rest decline. That's for sure too. In conclusion, Netflix stock is currently worth around $555. If it were to tank more, I'd start to get interested. Probably if it got down to like the $350 range. If it saw another 2022 type event where it got below $200, I would absolutely buy. Right now, I'm just keeping it on my watch list. But if you want, join our community to see the stocks that I have been buying. So let me know what you guys think of Netflix. Drop us a comment below, like and subscribe. And if you're interested, sign up for my Substack linked in the description below. You can become a free subscriber to read all my articles, or a paid subscriber if you're interested in community access where I'm sharing all my trades and we're doing weekly Zoom calls. This is Vinny from the Investment Club. I'll see you guys next time.